Welcome to the Deep Dive, your shortcut to being genuinely well-informed. We take a stack of information, dive deep, and pull out the most important nuggets of knowledge and insight for you. Today, we're plunging headfirst into the world of renewable energy. We're focusing on a major player, Canadian Solar, traded on the NASDAQ ticker CSIQ. And just so you know, all the insights we're sharing today are anchored to the market close on June 17, 2025. CSIQ's share price then was $10.60.
Right, and this is a company operating in, well, an incredibly turbulent industry right now. You've got intense price wars, really complex geopolitical tariffs, not to mention volatile interest rates. Amidst all this chaos, Canadian Solar has made a pretty significant strategic pivot. They're saying, look, we're prioritizing profitability over just shipping massive volume.
Exactly. So the central question we're unpacking today is this bold move a disciplined masterstroke? Or, maybe a desperate gamble just to survive? We're going to dissect the business, its leadership, the financials, and the, frankly, immense risks it faces, all through the disciplined lens of a value investor. And definitely stick around with us because we'll be teasing out a fascinating conclusion. It could really redefine how you view companies trying to navigate these really turbulent markets. Before we dive into the details, though, if you're looking for these kinds of in-depth analyses on specific stocks, please do hit that like button and subscribe to the Stock Analytics AI YouTube channel. Seriously, for just $4.99 a month, members get priority deep dives on the tickers they suggest in the comments. Worth checking out. All right, let's unpack Canadian Solar. We'll start with part one, covering the business, management, and financials. Okay, let's kick things off with chapter one, the business, a vertically integrated player in a turbulent market. So what exactly is Canadian Solar? How does it operate in this complex landscape? It sounds like maybe two businesses rolled into one.
You pretty much hit on it. Yeah, at its core, you have the CSI Solar segment. That's the manufacturing powerhouse. It generates, about 60–70% of their total revenue. They're vertically integrated, which is key. It means they control a lot of their supply chain, producing everything from the raw solar ingots, the silicon material, right up to the high-efficiency modules and panels themselves. And crucially, they've also made a big push into battery energy storage solutions, or BES. They offer everything from like the residential EP cube systems homeowners might use to massive utility-scale solar bank systems.
Okay, so manufacturing is one side. What's the other piece?
That would be the recurrent energy segment. This typically brings in, say, 25–35% of their revenue. This division is their global project developer. They build the big stuff, utility-scale solar plants and large battery storage projects. What's particularly interesting here, though, is their strategic shift. They used to mostly operate on a develop-to-sell model, build it, sell it off quickly.
Ah, okay.
But now they're moving to more of a hybrid approach. They're increasingly retaining ownership of these assets. This lets them become an independent power producer, an IPP, generating stable, long-term, recurring cash flows, which is, attractive.
Makes sense. More predictable income.
Exactly.
Yeah.
And they also provide ongoing operations and maintenance O&M services for these projects. That adds another layer of that predictable revenue.
So really covering the whole life cycle in some ways, a comprehensive player then. What about their market position, their scale? Are they a big fish?
Oh, they're formidable, no question.
Yeah.
Founded way back in 2001 by Dr. Sean Kwa. They delivered over 118 gigawatts of modules. That's a huge amount. To over 160 countries.
118 gigawatts. Just put that in perspective for us.
Right. Well, a gigawatt is a billion watts. 118 GW is enough power for tens of millions of homes. It's massive scale. And it places them firmly among the world's elite solar companies. Industry projections for 2025, they're looking at maybe #6 globally, shipping around 25 GWs. Wood Mackenzie even ranks them #4 worldwide.
So a top-tier player.
Definitely. Their value proposition really is being this bankable, vertically integrated, tech-advanced provider, a one-stop shop for big customers, utilities, large corporations.
Okay, now here's where it gets, I think, really interesting. The solar industry itself, it seems like a sector of extreme contrasts, doesn't it?
Absolutely.
Long term, the future looks incredibly bright. You've got climate commitments, plus these huge new demand drivers, like the staggering energy needs of AI data centers. I saw a projection of 5.5 terawatts needed by 2030. A terawatt is 1,000 gigawatts. Just mind-boggling numbers.
It is. The long-term tailwinds are undeniable, but the immediate picture, very, very challenging.
How so?
There's a global manufacturing overcapacity, a lot of it coming out of China, that's caused module prices to just collapse. It's devastated profitability across the board. And then you add macroeconomic headwinds like high interest rates. That suppresses demand, especially in the U.S. residential solar market that saw a 13% decline in Q1 2025.
Wow, 13%.
Yeah, and overall, U.S. solar installations fell 7% in that same period. So tough near-term conditions.
And I imagine the competition in that environment is just ferocious.
It is. In module manufacturing, they're battling Chinese giants like LONGi, Jinko Solar. And in the U.S., you have First Solar with its different thin film technology that gets around some tariffs. Then in project development, they compete with huge Chinese state-owned enterprises and big U.S. players like SOLV Energy. It's a crowded field.
You mentioned tariffs. The U.S. regulatory environment sounds like, well, a minefield.
It really is. You've got this incredibly complex web of trade tariffs impacting their global supply chain. There's Section 201 tariff, Section 301, which, by the way, jumped to 50% for solar cells, plus anti-dumping and countervailing duties, AD/CVD on imports from key Asian manufacturing hubs.
So just constant cost pressure and uncertainty.
Huge cost pressure, yes, and massive uncertainty. A single adverse ruling could hit their profitability overnight. It's that volatile.
But there's a flip side with U.S. policy, right? The IRA.
Exactly. The Inflation Reduction Act, the IRA, offers really powerful tax credits and incentives for domestic manufacturing. That's a key reason Canadian Solar is building these new factories in the U.S., Texas, Indiana, Kentucky.
Trying to navigate that minefield.
Precisely. But then you also have state-level policies working against them sometimes, like California's NEM 3.0, that drastically cut compensation for homeowners selling solar back to the grid, hitting residential demand hard.
Okay, so with all that turbulence, what gives Canadian Solar a competitive edge? What's their moat, so to speak?
Good question. Their moat is built on, I'd say, several pillars. First is brand strength and bankability. Being consistently ranked a Tier 1 manufacturer is absolutely critical. It signals reliability, financial stability.
Which matters for getting projects financed, right?
Exactly. It lowers risk for lenders, helps them secure better terms. It's huge. Second, cost advantages and economies of scale. That comes from their vertical integration and just their massive global manufacturing footprint. And that decision to build plants in the U.S., it's a smart, dual-pronged strategy. It helps bypass tariffs and lets them capture those lucrative IRA incentives. That's a big long-term advantage.
Okay, what else?
Third, network effects and switching costs. They've been around since 2001, decades of relationships with utilities, big corporate buyers like Amazon, Microsoft. That builds trust, makes it easier to win new contracts. And their integrated model, especially with their own storage solutions, increases customer stickiness. It's harder for customers to switch away.
Like their energy storage division.
Exactly. Their e-storage division has, get this, a 91 gigawatt-hour pipeline and $3.2 billion in contracted backlog. That's fueled directly by their existing module sales channels. Powerful cross-selling.
Impressive backlog.
It is. And finally, unique assets and capabilities. Things like over 2,370 patents, manufacturing flexibility with different wafer sizes, and their own proprietary EP-cubed and SolBank storage systems.
Okay, that paints a clear picture of the business itself. But a company is only as strong as its leadership. Let's shift focus now to the people running it. This brings us to Chapter 2, Management Evaluation. The Stewards of Capital. Tell us about the founder and CEO, Dr. Sean Kwa.
Right. Dr. Kwa founded Canadian Solar back in 2001. He's still chairman, president, and CEO. What's interesting is he's a scientist by training, PhD in material science, not, a finance guy primarily.
Does that matter in this industry?
I think it's a significant asset, actually. Having that deep technical understanding in a tech-driven field like solar is really valuable. And he's successfully guided the company through many, many boom and bust cycles over 2 decades. He's seen it all.
So how has this management team responded to the current crisis, the collapsing prices?
Their response shows, I think, crucial adaptability. Faced with those falling prices, they've explicitly shifted their philosophy away from volume at any cost to a disciplined, profit-first approach, which seems like a very rational adaptation when your industry is just drowning in overcapacity.
Yeah.
And the fact that their Q1 2025 results actually met or even exceeded their guidance, despite those severe headwinds, well, that indicates pretty disciplined execution under pressure.
What about transparency for investors? And are there any sort of unique risks we should know about with Canadian Solar specifically?
Well, they maintain standard public company communications, SEC filings, the usual stuff. However, there is an important point here. As a foreign private issuer with significant operations in China, they are subject to the Holding Foreign Companies Accountable Act.
What does that mean practically?
It means if U.S. regulators, the PCAOB, can't fully inspect their China-based auditors for 3 consecutive years, well, it could potentially lead to their shares being prohibited from trading on U.S. exchanges.
So a delisting risk.
It's a non-trivial risk, yes, something investors absolutely need to be aware of.
Okay. How does management actually allocate capital? Where are they putting the company's money?
Their strategy seems clearly focused on reinvestment for strategic growth. We're seeing major capital outlays, big spending on a new U.S. manufacturing capacity, and also on building out the Recurrent energy project development pipeline.
Any M&A activity, mergers or acquisitions?
It seems very targeted. Like their investment in a company called Habitat Energy, which uses AI for optimizing battery storage performance. Strategic bets. But what's really fascinating, I think, is the $500 million investment from BlackRock, specifically into the Recurrent energy subsidiary.
BlackRock, okay. It's a big name.
It's huge. And it's more than just cash. It's a massive third-party validation of Recurrent's project pipeline and their new hybrid IPP strategy. It really helps de-risk that capital-intensive shift they're making towards owning assets long-term. A major vote of confidence.
Right. And for shareholders directly, what about dividends or share buybacks? Are they returning cash that way?
No, Canadian Solar does not pay a dividend. And that seems like a very deliberate choice.
Why is that?
To reinvest every single dollar into these high-growth opportunities, energy storage, U.S. manufacturing.
Right.
That seems to be the priority. They've opportunistically repurchased shares in the past. There was a $150 million program back in 2019 when they thought this stock was undervalued.
Not now, even with the low price.
Apparently not on a large scale. The absence of a big buyback program today suggests management sees these strategic investments as, well, more compelling uses of capital right now.
Okay, so the ultimate report card for how well management uses that capital is return on invested capital, ROIC. What does CSIQ's ROIC tell us?
Yeah, ROIC is key. Theirs has been highly volatile, which frankly is typical for a cyclical industry like solar. You see big swings. As of the most recent trailing 12-month period, though, it's actually near zero or slightly negative, hovering around 1% or maybe 0.02%.
Ouch. Not great.
Not great recently, no. It directly reflects that compressed profitability we talked about and also this massive capital investment cycle they're in. The entire bull case, the whole argument for the stock going up, fundamentally rests on these investments they're making today, leading to a dramatic, sustained improvement in ROIC in the coming years. That's the bet.
Okay, makes sense. Let's turn now to the cold, hard numbers. Time for Chapter 3, Financial Analysis, a health and valuation checkup. What do Canadian Solar's financials tell us about its health and valuation as of that June 17th, 2025 date?
Right, let's do a quick snapshot of the key metrics. Market cap total value of shares was $709.91 million. Share price, $10.60. But importantly, their enterprise value, which includes debt, was much higher, $6.04 billion. That debt level matters.
Okay.
They had about 66.97 million shares outstanding. Their PE ratio, price to earnings, was negative because of recent losses. But maybe more telling is the price-sales ratio. It was remarkably low at 0.12x.
0.12 times sales, what does that signal?
Well, a low price sales like that often suggests the market thinks the company is undervalued relative to its revenue. It signals deep market pessimism about its future profits. Their debt-to-equity ratio, measuring leverage, was 2.46, and their current ratio, looking at short-term liquidity, was 1.07.
Let's dig into performance trends. Revenue growth, profit margins, free cash flow. How have those looked?
Revenue has seen significant growth over the years, but also a lot of volatility. That reflects the cyclical nature of the solar market. Annual revenue grew from about $5.3 billion in 2021 to a peak of $7.6 billion in 2023.
Quite a jump.
Yeah, but then it fell back to about $6 billion in 2024. Still, over 10 years, their revenue, CAGR compound annual growth rate, is a respectable 6%.
Okay, but what about profitability? That seems to be the sore spot.
It is. Profitability is their most acute challenge right now. Margins are just severely pressured by that industry-wide price collapse. Q4 2024 gross margin was only 14.3%. Full year 2024 saw negative operating income of $30 million, and net income was razor thin, just $36 million.
So barely profitable in 2024.
Exactly. The key thing for investors to watch, though, is management's forecast. They're guiding for a significant rebound in gross margins to 23-25% in Q2 2025. That's a critical number.
Now, one of the most striking numbers you mentioned is free cash flow. Deeply negative, you said. What does that specifically mean for a value investor?
Yeah, for the trailing 12 months ending March 31st, 2025, free cash flow was a staggering negative $2.67 billion.
Wow. Billion with a B.
Billion with a B. Now, if you look at that in isolation, it's a massive red flag, major cash burn. However, you have to understand why. This cash burn is primarily a direct result of those aggressive strategic investments we talked about.
The U.S. factories, the project pipeline.
Exactly. Massive capital expenditures for the new U.S. facilities and building up those project assets in the recurrent energy segment. So the core analytical question isn't just that they're burning cash. It's whether these investments will generate a high enough return on capital in the future to justify consuming all this cash right now.
Got it. So what about their overall financial stability, earnings consistency, debt, liquidity?
Earnings are highly inconsistent. They swung from a healthy $3.87 EPS earnings per share in 2023 to a loss of -84 by March 2025. Big swings. They use significant leverage, as that debt-to-equity ratio of 2.46 shows. While it has been higher in the past, it still definitely increases financial risk.
And liquidity.
The current ratio of 1.07 means they can cover their short-term liabilities technically, but there's not a large cushion there. So it warrants close monitoring. And, as we said, no dividend.
Okay, finally, the big question everyone wants to know. What is CSIQ actually worth? How do we value this thing?
Right. From a relative valuation standpoint, comparing it to peers, the stock looks exceptionally cheap. The PE is negative, so not useful. But that price-to-sales ratio of just 0.12x, that's a massive discount compared to the industry average of around 3.7x.
Huge difference.
It screams deep market pessimism. And it raises that classic value investor dilemma. Is this a fantastic deep value opportunity, or is it a value trap waiting to spring?
And what about intrinsic value, trying to calculate what it should be worth?
For intrinsic valuation, we can use a discounted cash flow or DCF model. That projects future cash flows back to today's value. Based on analyst consensus estimates and assuming a revenue rebound and that margin recovery management is guiding towards, the DCF model suggests an estimated intrinsic value of around $43.01 per share.
$43 compared to the $10.60 price.
Exactly. Now, to account for all the uncertainty in this volatile industry, a reasonable educational estimate might be a range, say $35 to $50 per share. But it's absolutely crucial to understand this is just an estimate. It's highly contingent on them successfully executing that ambitious strategy and the market normalizing. Lots of ifs.
Understood. That wraps up a very detailed part one. When we come back, we'll dive into market sentiment, who owns the stock, and the significant risks this company faces. Don't go away.
Welcome back to the deep dive. We're diving into part two of our look at Canadian solar. Let's start with chapter 4, market sentiment, reading the tea leaves, beyond the numbers, beyond the business structure. What's the collective mood? What's Wall Street saying? What's the media vibe about Canadian solar? Well, the market sentiment is deeply polarized, which is really interesting to see. The consensus rating from Wall Street analysts, it's a resounding hold, which basically reflects that tension. They see the long-term potential, but they're very wary of the significant near-term risks.
A hold rating often means uncertainty, right?
Pretty much.
Yeah.
And you see that uncertainty reflected in the extremely wide dispersion of price targets analysts have put out. They range from a pessimistic low of maybe $7 or $8.
Wow, below the current price.
Yeah, all the way up to a much more optimistic high of $23 to $27. For instance, Goldman Sachs has a sell rating with a $9 target, but Mizuho rates them outperform. Big disagreement.
And the news headlines. What's the general narrative there?
Recent news has generally been cautious. A lot of focus on their Q1 2025 net loss, although importantly, it was narrower than many analysts had feared. And there's ongoing commentary about the complex impact of U.S. tariffs. The general tone seems to acknowledge the market challenges, definitely. But it also gives credit to management's strategic moves in energy storage and U.S. manufacturing as potential positives.
With such divided opinions, what are the market indicators telling us, particularly short interest people betting against the stock?
Ah, yes. Short interest is flashing bright red for Canadian solar. It's high. Depending on the source, you see somewhere between 18.77% and 23.54% of the publicly traded shares currently sold short.
That's a huge chunk.
It is. It means a significant portion of presumably sophisticated investors are actively betting the stock price will decline further. And you couple that with a high days to cover ratio, 6.4 to 13.6 days. That measures how long it would take shorts to buy back all shares based on average volume. A high number means it could take a while, increasing risk for them.
What does that high short interest create, potentially?
It creates significant potential for volatility. This extreme polarization means the market is truly a battleground. You've got bulls who see deep value clashing with bears who see a value trap.
And this kind of setup, high short interest, often creates the potential for a short squeeze, doesn't it?
Precisely. If there's unexpectedly positive news, maybe a surprisingly strong earnings report, a favorable tariff ruling, a major new energy storage contract, anything like that. It could force those short sellers to scramble and buy back shares quickly to cover their positions. That buying pressure can fuel a rapid, sharp price increase. It's a possibility.
Okay, switching gears slightly. From a technical analysis perspective, charts and moving averages, where does the stock stand?
As of mid-June 2025, that $10.60 share price was actually trading above its 50-day simple moving average.
Which means?
That's often seen as a short-term bullish signal, suggests some recent upward momentum. However,
There's a however.
there is. It was still trading below its 200-day simple moving average. And that indicator suggests the longer-term downtrend that has been in place hasn't really been broken yet. So, mixed signals technically.
Got it. Understanding who owns a company can be just as critical as the financials. Let's move to Chapter 5. Ownership structure. Who's at the table? What does Canadian Solar's ownership structure reveal? Who holds the shares?
Well, institutional investors, large funds, asset managers, they hold a significant stake, somewhere between 42% and 50% of the company. And this ownership is relatively concentrated. The top 7 shareholders control more than half the institutional stake.
Who are some of the big names?
Firms like McKinsey Financial, Ivy Rock Asset Management, Invesco, the Vanguard Group, those are among the largest holders. Looking at recent activity, it's a bit of a mixed picture. Some institutions reduced their positions, while others actually significantly increased their stakes in Q1 2025. So, differing views there too.
But the standout feature here, the thing that really jumps off the page, is the insider ownership, isn't it?
It absolutely is, and it's a really powerful signal, I think. Insiders, primarily executives and directors, own a substantial 21% of the entire company.
21%? That's huge.
It's huge. And it's dominated by the founder and CEO, Dr. Sean Kwai. He personally owns about 13.9 million shares. That represents about 20.8% of the company. At that $10.60 share price, his stake was valued at over $147 million.
Wow. So he has serious skin in the game.
Extraordinary level of skin in the game. It powerfully aligns his financial interests directly with those of common shareholders like you or me. You could argue it's the strongest possible counterargument to the bearish thesis. The person who knows the company best has an enormous chunk of his personal net worth tied up in it.
That's a very compelling point. And what about recent insider transactions? Has Dr. Kwai or others been buying or selling?
Good question. A review of the public filing shows no open market purchases or sales by insiders over the last 12 months.
No selling either during this tough period.
No open market selling. The complete absence of selling by the CEO and other key executives during a time of intense market pressure and a weak stock price. Well, that in itself is a significant sign of confidence. It suggests they believe in the long-term story.
Okay, very interesting on the ownership front. Now, no investment analysis is complete without a clear-eyed look at the risks. Let's frame this using a SWOT analysis: strengths, weaknesses, opportunities, threats. This brings us to Chapter 6, risk assessment. Navigating the headwinds. Let's start internally. What are Canadian Solar's key strengths and weaknesses?
Okay, strengths. We've touched on many. Their vertical integration and scale, giving them that supply chain control. Technological leadership, over 2,370 patents. Advanced N-type cells. Their strong Tier 1 bankable brand, crucial for financing, that high 21% insider ownership we just discussed. And their growing high-margin energy storage business with that big $3.2 billion backlog.
And the weakness.
On the weakness side, definitely the high leverage, that 2.46 debt-to-equity ratio, is a burden. The significant negative free cash flow, negative $2.67 billion, is a major concern, even if it's for investment. And of course, their currently low and volatile profitability, thanks to those intense price wars, that's a key vulnerability.
Okay, now looking externally, what are the opportunities and threats facing Canadian Solar out in the market?
The opportunities are, frankly, massive. You've got the multi-decade global energy transition, a huge secular tailwind. The exponential growth predicted for the battery energy storage market, where they are very well positioned. Those new demand drivers like the huge energy needs of AI data centers, and critically, those lucrative Inflation Reduction Act incentives for the U.S. manufacturing plants. Big opportunities.
But then there are the threats, and these sound significant.
They are. Now for the threats. First, geopolitical factors, especially U.S. tariffs. This is arguably the most unpredictable threat. Their global supply chain, rooted in Asia, is directly impacted by Section 201, Section 301 with that 50% tariff on solar cells, and the ED/CVD tariffs.
We talked about the pressure and uncertainty there.
Immense cost pressure, immense supply chain uncertainty, and a single adverse trade ruling could materially hit profitability almost overnight. It's a constant threat. Their U.S. manufacturing investment is a direct attempt to mitigate this risk, but it's going to take years to fully insulate the company. It's not an instant fix.
What other major threats?
Second big one is the impact of key macroeconomic factors, things like inflation and interest rates. High interest rates are a powerful headwind. They increase capital costs for big utility-scale projects, and they dampen residential demand. People are less likely to finance solar panels when rates are high.
And if rates come down?
Well, the reason for future rate cuts matters immensely. If rates are cut because we're heading into a recession, the benefit of lower borrowing costs could easily be offset by collapsing energy demand. So it's complex. Plus, persistent inflation directly pressures their manufacturing margins, higher costs for raw materials, labor, logistics. It's a tough macro environment.
Okay, a lot to weigh there. So what does this all mean when we bring it together? How do we synthesize these findings for investors? Let's lay out the bull case and the bear case for Canadian Solar in our final chapter, Chapter 7, Conclusion, synthesizing the bull and bear cases.
Right, let's synthesize. The bull case, the argument for the stock, centers on several key points. First, deep value. It's trading at that exceptionally low price-to-sales ratio of 0.12x, way below peers. And our DCF estimate suggested an intrinsic value range of perhaps $35 to $50 per share, much higher than the current price. Second, the strategic pivot. That decisive shift to a profit-first model, plus the aggressive expansion into high-margin energy storage, that presents a clear, disciplined path towards improved profitability.
Makes sense.
Third, massive insider ownership. Dr. Kuei's 21% stake creates that unparalleled alignment and signals deep personal conviction in a long-term strategy. Hard to ignore. Fourth, those secular growth trends. The company is a key player in the global energy transition and potentially meeting the huge energy demands of AI, big tailwinds. And fifth, U.S. manufacturing. Onshoring production hedges against that geopolitical risk and lets them capture those lucrative IRA incentives. A powerful long-term advantage if executed well.
Okay, that's a compelling bull case. But what about the bear case? What are the arguments for further declines or reasons to be very cautious?
The bear case highlights equally critical points. You cannot ignore them. First, brutal industry headwinds. Intense global price competition, the manufacturing oversupply, punitive tariffs. These are actively compressing margins right now. It's happening. Second, high financial risk. The company operates with high leverage and is burning significant cash to fund its expansion. That makes it vulnerable if credit markets tighten or there's an economic downturn.
Execution is key too, right?
Absolutely. Third is execution risk. The entire bull case hinges on management successfully navigating this really complex, capital-intensive strategic pivot in a very tough environment. No guarantee of success. Fourth, the geopolitical minefield. Its fortunes are deeply linked to unpredictable U.S.-China trade relations. Things can change fast and hit them hard. And fifth, that high short interest. A large, sophisticated chunk of the market is actively betting that all these risks will ultimately overwhelm the company. They're putting their money where their mouth is.
So let's just summarize the valuation picture again. As of June 17th, 2025, share price $10.60, trading at a significant discount to that estimated intrinsic value range of $35 to $50 per share.
Exactly. But, and this is crucial, it must be emphatically stated, this valuation is an educational estimate. It is not a prediction, and it is highly, highly contingent upon the successful execution of the company's long-term strategic plan and some kind of normalization of these currently chaotic industry conditions. A lot has to go right.
Right. So Canadian Solar really presents a very clear, albeit challenging, proposition for investors, doesn't it? The market is currently pricing the stock based on those severe near-term headwinds and the significant financial risks, which are, frankly, undeniable. That wide chasm, that gap between the current market price and the estimated intrinsic value, it represents the profound uncertainty surrounding the company's future. An investment in Canadian Solar today, it's definitely not on the status quo. It's a calculated high-risk bet. A bet that this current industry storm is temporary and that management's strategic initiatives, especially in high-margin energy storage, and that tariff-advantaged U.S. manufacturing will actually succeed, and that success will unlock the significant underlying value of the company's global assets and market-leading position.
Well put. It really boils down to whether you believe management can navigate this storm and execute on that pivot.
So the question remains for you, the listener. Is Canadian Solar's pivot truly a disciplined masterstroke? Or is it a high-stakes gamble in a brutally competitive arena? And thinking more broadly, how does this tension, deep value versus significant risk, offset by strong insider conviction, shape your perspective on investing in these turbulent, rapidly evolving sectors? Something to think about. And that's our deep dive into Canadian solar. We really hope this analysis gave you some of those aha moments and helped you feel well informed, quickly, and thoroughly. Don't forget to like and subscribe to the Stock Analytics AI YouTube channel for more deep dives just like this one. Members get priority access to stock suggestions for future videos, so join for just $4.99 a month.
And as always, please remember this analysis was generated by an AI system. It's purely for educational purposes and should absolutely not be considered financial advice. Please do your own research or consult with a qualified financial advisor before making any investment decisions.
Thanks for diving deep with us today. We'll see you next time.